Okay, well, thanks for being on this webinar, everybody. Hope you're having a good week. We are starting here just with this disclosure slide as we talk about the 2023 review and go through a 2024 discussion on what's to come. We certainly hope that you find this information helpful. And if you have any follow-up questions, Kevin and I and anyone on our team is certainly happy to assist. So thank you for getting on, and feel free as you listen to this presentation, if there is anyone that you think might want to listen to it, you're welcome to either provide us their information, we can forward this on to them, or you can get the link off of our website. I figured since we're talking about 2023 review, I should talk with you about the joke that got 2023 Financial Planner of the Year award. And there's two of them that I'm going to bring up because it's a tie, 50-50 to me. So number one was, what's another name for a long-term investment?
What's that?
A failed short-term investment.
Oh boy.
I heard somebody say that. The other one, so this one is, it was given to me by a client, so I'm gonna read it. Thought it was kind of funny. So a dad sends his son to a food shop for Sunday brunch, and as the boy approaches the counter, he sees some bowls behind the glass display that are filled with unfamiliar foods. The first bowl has a sign that says Financial Advisor Brains, $25 an ounce. The second bowl says Physician Brains, $50 an ounce. And the third bowl said Economist Brains, $1,000 an ounce. So the boy asks the person behind the counter, why are Economist Brains so much more expensive than Financial Advisor's Brains? And the person replied, kid, do you know how many economists we have to go through to find an ounce of brains?
Oh, geez.
Yes, I nailed it. So it's interesting as we talk about 2023 and go into 2024. Every year, Kevin and I hear many, many, many different economists and their predictions, and they don't necessarily pan out. But they keep making the predictions, and we just try and find that one with the smartest brain possible. But it's tough to predict what's going to happen. Nobody knows that we were going to have a great fourth quarter for 2023. Nobody knows what the 2024 calendar year will bring. You got a presidential election year with a potential recession in there, whether that comes true or not. So there's a lot going on here, but we're happy to unpack this for you further in this webinar and individually as we would meet. I am just going to, before I turn it over to Kevin to start us off, I want to mention to everyone on this call that our next webinar is going to be on March 20th at 4 p.m. And that will be a workshop on taxes and the 20 questions every person must answer. So feel free to sign up for that. As you see, we'll send out a registration here in the coming weeks, but that will be our next webinar on March 20th at 4 p.m. And Kevin, I am going to turn it over to you.
All right. Appreciate that, John. Yeah, well, thank you everyone for joining us today for the presentation. As John mentioned, we're looking at 2023, a recovery like no other, and then also what's in store for 2024. So again, my colleague John and I are excited to co-present to you on this Valentine's Day. With the love that we both share for this topic at hand, we are certainly looking forward to sharing information with you. And why don't I just kick it off here talking about what we're going to talk about. So we have a quick roadmap. The 5 things we have: first, the year in review, how the markets fared last year. Then we have 5 key questions for early 2024. Then we go on to 4 main themes for 2024 brought to us by Goldman Sachs, their info. And then fourth, we use 6 evergreen investing principles And then lastly, 9 key strategies in a volatile market. All right, so why don't we dive in here? So as you can see from the bar chart, the market performance last year marked a clear, really departure from the year before, with several asset classes performing both better than they did in 2022 and also really above the consensus expectations, including specifically the U.S. large cap, which is represented by the S&P 500, and then also the U.S. small cap that's represented by the Russell 2000 index. Now, as we head into next year, or into, well, this year, 2024, we're certainly more optimistic on the state of the global economies than we were entering 2023. You know, as the cooling inflation and the likely ending of monetary tightening will return to us as normalized investing environment in our view. Ultimately, we believe that 2024 will signal a resurgence of the balanced portfolio. All right, as you can see from the graph, 2023 really marked a sizable turnaround in the S&P 500, also in the NASDAQ and the Dow Jones indexes, again, coming off a dismal 2022, in which all major indexes were down at least 8% for the year. All right, so worth noting is that the performance of the S&P 500 index is the most concentrated it has been since the 1970s, with the likes of Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta. They gained between 48% and 239% in 2023. The Magnificent Seven, as they are called, are tech stocks that have accounted for most of the S&P 500 gains. Now, thanks to an increase in AI, investors are all in on the big tech, and these 7 stocks have racked up huge returns. In fact, Nvidia reached $1 trillion valuation for the first time ever as a result of the AI demand for semiconductor chips. With just 7 companies in the S&P 500 driving most of the performance, markets are certainly vulnerable to concentration risk. Now, the Magnificent Seven stocks have swelled to represent about 30% of the S&P 500's market value, according to Goldman Sachs Global Investment Research. And that is approaching the highest ever share for any 7 stocks. So it's really a mind-blowing number to me when I think about an index that's supposed to represent such a broad group of companies, said Anne Maletti. She's the head active equity person at Allspring Global Investments in regards to the wide outperformance gap. All right, also, as you can easily spot on the bar graph on the far right, the bond index returned minus 13% during calendar year 2022, which was the worst since the index began back in 1976. Then, last calendar year, the bond index returned 6%. And then that was after fighting through the interest rate hikes that we had and also the banking turmoil. So last year, the bond index did eke out positive returns, keeping in mind that over the long run, diversification has proved to be really a winning strategy. And I also wanted to note that over the past 15 years, the annual return on a diversified portfolio of stocks, bonds, and other uncorrelated asset classes is just over 6% per year, according to JP Morgan. Lastly, following bad years of performance, bonds tend to deliver strong returns. All right, as for inflation, the Fed's preferred gauge is the Core Personal Consumption Expenditure Price Index, which also goes by PCE. And really the Fed is trying to keep that lower, around 2%. But if you look back to the beginning of the fourth quarter, back in October, prices fell the previous month, making that the first decline since 2020. And then at the same time, the Federal Reserve's preferred inflation metric cooled more than expected. So that's a development that can really be, cheered by the central bank officials looking for a sustained slowdown in price growth. Now, the central bank also predicted that the Core Personal Consumption Expenditure, again, the PCE, price index will decline to 2.2% by 2025 and finally reach its 2% goal by 2026. So now these new forecasts suggest a softer inflation picture in the next 2 years than from the last update in September. Also, a gauge the Federal Reserve uses for inflation rose slightly in November, and then it edged closer to the central bank's goal. The core PCE price index, which excludes more of the volatile areas of food and energy prices, increased 0.1% for the month, and then was up 3.2% from a year ago, compared to economists surveyed by the Dow Jones that had been expecting respective rises of 0.1 and 3.3. So lastly, on a 6-month basis, core PCE increased 1.9%, really indicating that if current trends continue, the Fed essentially has reached its goal, which is something that John and I will continue certainly to keep an eye on. Now, with respect to unemployment, as you can see here in the slide, the unemployment rate decreased to 3.7% for the month of November, and then it held steady in December, which was down from 3.9% a couple of months earlier in October. So the U.S. unemployment report for December shows 216,000 jobs were added in the month, which is much more than the 175,000 economists polled by Bloomberg, as they had predicted. Now, the U.S. economy grew even faster than expected in the third quarter. It was really buoyed by a strong consumer spending, really in spite of the higher interest rates, in spite of the ongoing inflation pressures, and also in spite of a variety of other domestic and global headwinds. Also global domestic product, which again is a measure of goods and services produced in the United States, it rose at a seasonally adjusted annualized pace of 4.9% during the July through September period, which was up from an unrevised 2.1% pace in the second quarter, as was reported by the Commerce Department. This 4.9% was in comparison to economists surveyed by the Dow Jones that have been looking for a 4.7% acceleration in GDP, which also is adjusted for inflation. All right, so since the beginning of 2022, the Fed has hiked rates by a cumulative 5.25%, really in an attempt to combat persistent and high inflation. So at their December and January meetings, the Fed voted to leave the federal funds rate unchanged at the target rate of the 5.25 to 5.5%. Now, the Fed rates influence the cost of borrowing. It impacts mortgages, it impacts credit cards, and also business loans. Now, the Federal Reserve currently plans to cut rates in 2024, but certainly time will tell whether or not that'll happen. All right, so when we look at the presidential election coming up later this year, many investors report worrying about the impact of the 2024 election on their portfolios. But, these fears are likely overblown. If you look across the entire ballot, there's not enough historical evidence to support investors voting with their portfolios rather than their personal and political beliefs. So with that said, the policies implemented by elected officials are important, especially with the next administration being responsible for addressing the expiring provisions in the Tax Cuts and Jobs Act. All right, so let's go to the 5 key questions for the first part of the year. All right, first we have, so as can be easily seen on the bar graph with the spike, consumers accumulated a peak of $2 trillion in excess savings from March, beginning of the pandemic, to August of 2021. Then since August 2021, though, consumers have drawn down on those excess savings and the personal savings rate has certainly fallen. So during the first year of the pandemic, the savings rate skyrocketed as the shutdown in activities and the large fiscal transfers filled consumers' wallets. But then as businesses returned to normal, the pent-up demand and rapidly rising prices really forced consumers to draw down on their excess savings to fund their spending habits, causing the savings rate to fall below average levels, which can easily be seen on the far right of the bar graph here. All right, so as some of you may remember, at their peak in the summer of 2022, consumer prices were increasing at a staggering 9.1% per year. Now, in comparison, as of November of last year, consumer prices were increasing at just 3.1% per year. These rapid price increases during 2021 and 2022 certainly have strained American household budgets, followed by inflation cooling in late 2023, which provides hope of a soft economic landing. Now, in general, price levels have not reversed the big run-up that happened just after the pandemic, as things like rent, car repairs, groceries, etc., remain more expensive on paper than they were in 2019. So all in all, prices are still climbing, but just not as quickly as they once were. So as a reminder, the Federal Reserve, which is responsible for trying to restore price stability, wants to return price increases to a slow and steady pace that is consistent with a sustainable economy over time. Like other central banks around the world, the Fed defines that as a 2% annual inflation rate. Now, if the Fed ends up cutting interest rates later this year, as we expect, total returns across fixed income looks favorable with both attractive yields and also the potential for strong price returns. Now, historically, treasuries and core fixed income provides a reasonable hedge against the equity market. Keeping in mind, this relationship did break down in 2022 as rising interest rates sent both stocks and bonds tumbling. Now, as inflation moderates and investors gain more clarity on the path for interest rates, this inverse relationship should reassert itself. If interest rates do indeed fall later this year, as can be clearly seen on the chart here, the impact of just a 1% fall in interest rates could provide strong total returns across fixed income. Now, this chart shows the peak 6-month certificate of deposit rate during previous rate hike cycles, and then the subsequent 12-month total returns of CDs. It also shows the Bloomberg U.S. Aggregate Index. That's essentially a dorsal broad index. And then you have the S&P 500 and also a 60-40 portfolio, which that consists of 60% stocks and then 40% bonds. So as a result of the Fed's aggressive tightening campaign, CD yields have risen considerably and now look very attractive, especially in comparison to available CD rates even 2 to 3 years ago. However, investing at peak CD rates in the past has resulted in underperformance relative to other riskier asset classes across both stocks and bonds. So really the takeaway here is that investors must realize that there may be better options for deploying excess capital really outside of CDs that we can certainly help you take a look at. All right, so when thinking of the S&P 500 index, as of the end of last year, the top 10 companies in the index we had Apple, Microsoft, Amazon, NVIDIA, Google, Meta, Google. There's actually 2 classes in the top 10. Then you have Tesla, then you have Berkshire Hathaway, and then we had Broadcom, and also JP Morgan. So now the above chart shows the performance of those top 10 and of the bottom 490 stocks in the index, in addition to the actual index itself. So performance last year really was dominated by the top 10, which accounted for over 90% of the index's return. So as such, this has left the top 10 stocks quite expensive relative to the S&P 500. Also, the weight of the top 10 companies in the S&P 500 have been steadily increasing over the past few years. The onset of COVID really accelerated this trend, and as investors piled into these 10 names, leading them to outperform on the way down, as well as on the way back up. So then if we fast forward to today, with moderation interest rate expectations and the market's enthusiasm for AI spurring another rally, the weight of the top 10 now is sitting at 30% again. All right, well, that's a lot of information there. So John, I'll turn it over to you to continue with the second half of the presentation. So it's all yours, John.
Okay, thanks, Kevin.
Bet.
2024, what is the market going to do? So I have been in this business for 24 years now. I started in the year 2000. When I started, a wise man gave me this gift and said, this will tell you what the market's going to do. So this was my crystal ball. This is what I thought was going to give me a great career, because I always know what the market's going to do. But I took it home and I looked at it and I looked at it, and it never gave me the prediction of up or down. So I went back to that person and I said, this thing doesn't work. How do I use it? And they said, this isn't predicting the year-to-year market returns. This is predicting the 20-year market returns, and it's pointed up. And that's what happens. The market goes up over a long period of time, but to guess what the market's going to do in any given calendar year is impossible. There has been no talking head on the TV that has been right consistently. And I love reading material about past predictions because all the people that you think of as smart on TV, they've all been wrong. So take all of this with a grain of salt in what 2024 is going to bring, because you don't know the short-term headline tomorrow that will affect the markets. But I want to spend more time talking about what I would call evergreen investment principles in this latter part of the webinar. But I'll maybe just touch on some things from 2024 that Goldman Sachs provided here. So this is looking at the higher interest rate environment that we're in. And the graph that you're looking at, the dark column was February 2020 and where interest rates were economic. If you look at the next column down, that's the pandemic low. So 2020, interest rates dropped significantly. And we were down basically at that 0% level. And then if you look at where we are now, the lighter purple, you can see it is much, much higher than we were back in February of 2020. Obviously higher than we were at the pandemic low in 2020. And looking at this interest rate environment, it's just a much different period of time. And there's really two schools of thought there from an asset allocation standpoint. You think stocks, you think bonds. It'll be interesting how the stock market will perform at these higher interest rate levels because everything's more expensive. It costs more money for companies to get a loan. That's going to slow growth. I mean, before you had 2020 and beyond, they kept interest rates so low that you could get very cheap money. And you can kind of we lived our daily lives like that too. I mean, the mortgage rates that we were all able to lock in or refinance to will probably never happen again the rest of our lifetimes. You had 30-year mortgages in the low 2% range. Now they're what's in the 7s. And even then, there's probably a lot of people on this call that remember 7 would be a good number because they were in the lower double digits in the 80s. So if you look at that from a stock market standpoint, it is predicted that these interest rates stay higher for longer, even though Kevin mentioned earlier in the webinar, there is slight predictions that interest rates will come down in 2024, but not significantly. And just a few days ago, we had a really bad day in the market because inflation numbers came out that weren't as good as the market was hoping, in which case that led the market to think, oh boy, they're not going to decrease interest rates anytime soon because inflation has stayed higher than what was expected, and the market kind of took a dive that day. So it'd just be interesting to watch this interest rate environment. A lot of what the Fed does is in regards to the inflation and job numbers. But from a bond perspective, higher interest rate is good, right? Because if you have a bond, if you have a CD, you're going to all notice that the interest rates, we're just in a higher interest environment. You can earn more on your money. If you think about things from a bond perspective, typically the 10-year average rate of return of bonds is what the interest rate that you get into those bonds on day one. So if you look at this 5 to 6% range here, current interest rates, that would tell you that over the next 10 years, bonds will probably average around 5 to 5.5%. Because again, just from a bond perspective, it pays interest, and then at the end of the term, you get your money back. So really, long-term bond performance is extremely correlated to what the yield is when you buy those bonds. So that's a nice thing about the bond market these days is you're getting a higher interest rate. That's going to help during periods of stock market volatility when stocks aren't doing too well, is at least the bonds are paying more than zero like they were back in 2020. So that should help stabilize portfolios, unlike the last few years where bonds have struggled. talking about geopolitics. I mean, that's a big thing that a lot of questions are coming out about the presidential election year. And ultimately, that's typically a good thing. I mean, the first half of a presidential election year is usually flat, and then the third quarter is one of the better quarters that we have statistically. But looking at the geopolitical environment, this chart is showing how the trade restrictions have tripled since 2017. So you can see here the lower trade restrictions below the 500 mark. And then 2020, 21, 22, 23, they stayed elevated. That typically is not great for overall global growth when you have these types of restrictions. So it'll be interesting to see how that plays out with a potentially new political environment going forward. But it has been elevated pretty significantly over the last few years, ever since this 2017 run-up that you're seeing on this chart. So those first two slides really would say, yeah, it's probably not going to be a really great market environment going forward. Not necessarily negative, but not big double-digit performance. But on the flip side, you have these two little letters, AI, and that is changing the marketplace. You look at what this artificial intelligence is going to do from a productivity growth standpoint in our economy, and the percentage increase is very dramatic. So the United States, these are all different countries here on this chart. United States is about 8 here from the right. I mean, along with Sweden and Japan and Switzerland and Hong Kong, really the United States is predicted to get the most productivity growth because of the artificial intelligence boom. And that's going to change the economy. That's going to change production. It's going to change what industries are doing well and what aren't. When you think about semiconductors, cybersecurity, healthcare, it will be very interesting to see how AI affects the market over the next decade. And certainly, as Kevin was mentioning in the earlier slides, 2023, you had 7 stocks dominate the market because of their AI potential. Doesn't mean those 7 stocks will continue to lead the way, but that really provided a huge rate of return for the S&P 500 last year, were those 7 stocks specifically to do with artificial intelligence. But where do we come back in all this? We don't know what specific companies are going to lead the way, because that will ebb and flow. There'll be many AI companies that people talk about now that they won't be talking about in a few years, because there'll be the next Amazon somewhere along. But our goal always comes back to diversification. And this slide shows the typical diversification of all these different types of groups. So on the top here, you can see family offices, a little bit farther down, pension funds, a little bit farther down, wealth managers, which basically more for retail clients, government agencies on the bottom, banks all the way on the bottom. And this just shows the diversification of those groups. And the non-retail individuals, you can see, have a lot more black in their asset allocation, and those are alternatives. So now when I say alternatives, what do I mean? Private equity, hedge funds, real estate, collectibles, venture capital, distressed debt. There's a lot of different types of alternative investments out there. Typically, you're not seeing that in the retail world, at least yet, because of the illiquidity of those investments. And usually people with their investments, they want liquidity. They want the ability to get at their money and not have it locked up or tied into something. But alternatives are becoming a much bigger part of portfolios, especially here in the endowments and foundations and family offices that you're looking at. The darker blue is stocks from a diversification standpoint. Lighter blue is bonds. White color is more cash, and then you've got some different categories defined other in this chart. But we are always coming back to this diversification, and not that we just do stocks and bonds, but we do want to look at alternative investments for an asset class. And there's many clients that have alternative investments because the alternative investment world is shifting in the sense that not everything is illiquid anymore. So it's not just a stocks and bonds discussion anymore. There's a lot more asset classes available in portfolios that weren't typically available for the retail investor. And that's what we're always going to have discussions about, is portfolio diversification, different things you can do to get the best risk-adjusted rate of return possible based on the risk that you're comfortable taking and what your plan has in store in terms of withdrawals. Going into these investing principles, just want to touch on what you're seeing here on the screen. Number one, stocks are an important component of a portfolio. I would say that in a year like 2022, which was the 7th worst year in stock history, I would say that in a year like 2023, which had an outstanding fourth quarter and calendar year. But it pays to own stocks long term. Not necessarily short term, but long term, it's always paid to own stocks. Number two, pullbacks are to be expected. We remember 2022, there'll be another one ahead. Not necessarily this year, but pullbacks happen all the time. So I want to show some information about that. Three, keep a long-term view to stay consistent with your long-term goals. Investing is just not a short-term thing. For our clients that need a lot of money in the short term, that money basically has to sit on the sidelines in higher yielding savings types of accounts, because you don't have the time frame to ride out a drop. We always want to consider a portfolio to be more longer term in nature. Now, people are taking money on an ongoing basis, but that's typically a fairly small percentage of the overall portfolio, in the 3 to 5% range, that it's not a significant part of their overall account. But the long-term view is very important. Non-recession bear markets are typically shallower and rarer. I would say a majority of economists think we have dodged the bullet from a recession standpoint, but you don't know. And because economists are wrong all the time, back to my joke at the beginning of this webinar, we never want to count on any certain market over a 12-month period of time, because the short-term headlines can really affect things in a great way. Number five, market timers miss out. Just don't think that you can do that successfully over time. I'll show you some information on that. 6, don't let your feelings about the economy torpedo your investment strategy. Hating the government is not an investment strategy. And whether it's Republican, whether it's Democrat, whether it's me, you can vote me in if you want to. I wouldn't want the job. But the market figures it out. Doesn't matter policy, market will figure it out. Doesn't matter high taxes, low taxes, market will figure it out. It's always been the case, and Republican, Democrat, animal, anything, market figures it out. So to kind of show some charts based on those 6 things, first thing here is stocks have gained money in the long run. What you're looking at is the S&P 500 from 1996 through the end of 2023. A lot of ups and downs in there. It's kind of been a yo-yo since 2022. If you look at just the S&P 500, we basically just made it back to where we were at the beginning of 2022. Everybody feels good about 2023 with this big surge that we had, but those lines are pretty even. Market hasn't gone anywhere the last 2 years, just kind of recovered from the bad 2022 overall. But a lot of people on this call will remember 2001 and 02, third biggest drop in stock market history, 49%. The 08 drop, second biggest drop in stock market history, down 57%. Then we had this big recovery here over time, topped out in 2020 before the COVID drop, 34% drop in 33 days. Shot out of the cannon through the end of January 2022, or the beginning of January, sorry. Then we had the bad 2022 and then the 2023 period. It's interesting, if you look at where we're at December 31st of 2023 versus where we were at March 24th of 2000, I mean, you can see the difference. Obviously, 2023 is a much higher market number, but the market was 30% more expensive back in March 24th of 2000 than it is today. And you might remember the dot-com bubble, but that really brought the S&P 500 to multiples that just were not sustainable over the long term. And then we had the dot-com bubble bursting in there, 9/11 was in there as well. But it's really about kind of valuations. Where are things right now from a price to earnings ratio standpoint? We're sitting here at 19.5. It's not necessarily cheap. We look at here at the end of this 08 drop when we had the break surge, that the PE ratio is 15. When the lower this PE ratio, the cheaper the market is, and vice versa. But 19.5 isn't as expensive as where we were back in January of 2022. And it's just something that you want to pay attention to over time, is just that are things really expensive? Are things really cheap? And right now, I certainly wouldn't say things are cheap, but they're not overly expensive that we have to expect some imminent drop, like what happened over here. And this, I always like the graphic of it, because it shows the calendar years of the S&P 500 from 1926 to 2023. And anything to the right of this black line here in the middle means the market was positive. This first area is 0 to 10%, then 10 to 20, 20 to 30, 30 to 40, 40 to 50, 50 and over. So for instance, this first box, 0 to 10%, means these calendar years, 1947, 1948, 1956, and so on, from January 1st to December 31st, the market went up in between 0 and 10%. Now, we always talk about, I mean, you probably hear in articles or listen to the news, the market average is around 9 to 10%. That's kind of this first box. Very rarely does the market earn 9 to 10%. It's either very high or very low. You can see a majority of calendar years, by far, the market performance is in between 10 and 20, but not too far off. 20 to 30 has a lot of calendar years as well. 2023 was one of them. 30 to 40, still a good number of calendar years in terms of market performance. 40 to 50%. 1933 and 1954, the market went up over 50%. It'd be great if 2024 was like that. I don't think so, but hey, you never know. Now, on the flip side, nobody likes the downside. And if you look at 0 to 10% down, 10 to 20, 20 to 30, 30 to 40, and over 40% drop. We've had one market calendar year where the market dropped over 40%. That was 1931. We had 2 calendar years where it dropped between 30 and 40. 08 being the most recent. 20 to 30%, 3 calendar years. By far, if a calendar year drops, typically it's in the 0 to 10% range. But the nice thing is, this side of the ledger is a heck of a lot more busy than the left side of the ledger. 75% of calendar years, the market is on the right side, positive. 25% of calendar years, the market's on the negative side. So 3 out of 4 calendar years are up. You just don't want to take a chance. If all you have is a year, yeah, betting on the market 75% of the time you'll make money, but it's So that's why that's almost too aggressive in our mind, is taking a 1 out of 4 chance. But every year we have volatility. Good years, we have volatility. Bad years, we have volatility. And the media lets you know about it. So this chart goes back to 1980. And the gray lines are the calendar year performance. So from January 1st to December 31st, what did the market do? That's this gray, these gray columns. The red dot shows that sometime in that calendar year, the market dropped by that number. So for instance, if you look at 2023, had a positive year, but from a high to a low in 2023, the market fell 10%. So if you picked a certain day to invest in 23 and it was the wrong day, you could have lost 10% of your money, then panicked and got out, versus being in the market for the full calendar year and just earning 20+% rate of return. You look at 2022, that was a bad year. The market was down. But at the peak, it was down 25%. Before that, good calendar year. There wasn't really much volatility in 2021. 2020, the market was up 16%, but we had the COVID drop, where market from high to low fell 34%. So if you look at all of these intra-year drops, the average intra-year drop is over 14%. So at some point in the calendar year, on average, the market's going to fall 14%. And that's hard. It's hard for investors to go through that type of drop, see it on your statements. We don't know what quarter that's going to happen. But over time, that drop tends to be negated by positive performance. So here we're looking at kind of that time frame discussion. Why should we invest for the long time frame? Well, it's because of this picture right here. Green is stocks, blue is bonds, and the gray is half and half, 60% stocks, 40% bonds. And if we look at over a 1-year period of time, stocks can have a really bad 1-year period. Stock can have a really good 1-year period. In bonds, yeah, the drop isn't as significant, but it's still down 13%, thanks to 2022, worst year in bond history. And then 60-40 portfolio. All of these downsides, we would say that's too big a chance here that you would lose money. A 1-year period of time to invest, we don't want these chances of losing money like this. If you look at 10-year rolling periods, so now you're investing for more than just a 1-year rolling period, you're investing for 10. Now those drops are basically nothing. There has been a 10-year period where the market fell 1%, extremely rare. But typically that's positive. Never been a 10-year period where bonds were negative. Never been a 10-year period where a 60-40 portfolio was negative. And then 20-year periods, and same thing. So over time, as you invest, you lose this downside because you gave it time. And the total annual average return through all the ups and all the downs, stocks at 11, bonds at 5.5, 60-40 portfolio at 9.3. So if you invested $100,000 over 20 years, that's what you would have made. Looking at here, a nice thing about bull markets, bear markets, is we are typically in a bull market, they last a lot longer. So from a bull market perspective, on average, the market goes up 339%, and we're in a bull market for 6.6 years. That's the fun time. That's where we're inviting a lot of people in to talk, because, hey, everything is good. Just kidding. We want to talk to you just as much in the bad times too. So bear markets on the flip side, don't last 6.6 years on average. They last 1.3 years. So it's a much reduced period of time. But during that 1.3 years, the average drop in a bear market is 38%. And that's hard. It's hard to see dollars go down almost 40%. But you hang in there, wait for the bull market where it goes up 339%, and then you can kind of take a breather there. In terms of the longest bull market in history, that was 2009 to 2020. We had an 11-year period of time where we just were in a bull up market. Largest bear market was 1937 to 1942. It lasted about 61 months, so 5 years. Great Depression, worst market drop in history. 08 was the second. 2001 and 02 was the third. Just some interesting history for bear and bull markets I thought you would like. And then this one's very interesting. If you look at missing the best market days, so let's go back 1993 to 2022. I'm going to concentrate on this side of this slide first. So from 1993 to 2022, if you would have invested $10,000 back in 1993, that grew to $158,434. If you just fell asleep for 30 years. If you missed the 10 best days, 10 days out of 30 years, you made 54% less. And your 10,000 grew to 72,000. If you missed the 20 best days out of a 30-year period of time, your 10,000 grew to 42,000, 73% less. And if you missed the 30 best days, your 10,000 grew to 26,000. 30 days out of 30 years. Now, when do those good days happen? They don't happen in the bull markets all the time. 52% of those best days happened in a bear market, meaning the market was sliding down. 26% happened during the first 2 months of a bull market, and then 22% happened during the rest of the bull market. But over half of these days, the best 30 days, half of them occurred in the bear market when nobody wants to be invested because the market's going down. Moral of the story, do not miss the 30 best days over the next 30 years. Now, this kind of is along those same lines. This just shows the average rate of return of the market. Now here we're using a different time frame. Instead of 30 years, let's use 20 years, 2001 to 2021. If you put in $10,000 and fell asleep for 20 years, you made $61,000 in the market, averaged a 9.5% rate of return. You missed the 5 best days, you made 7%. Your 10,000 went up to 38,000. If you missed the 40 best days, you didn't make any money, you lost. So over the last 20 years, 40 days caused all the upside, because otherwise you were in a negative rate of return. That's nuts. You missed the best 50 days over 20 years, you were down half. Your 10,000 lost half of it, down to 5,100. And you missed best 60 days, you lost almost 70% of your money. Stay invested. Holy cow. Okay, looking at the economy. Okay, good times, everyone's feeling good about the economy. Then there's bad times, people are feeling horrible about the economy. That's kind of that hating the government conversations that we have. Is that a sign? So there's something called the Consumer Sentiment Index that is measured. Are people feeling good? Are people feeling bad? That's this line right here. The consumer sentiment index is this dark line. When it's high, kind of the peaks of this consumer sentiment index, when people are feeling good, what does the market do? Well, that's these numbers: -6, +1, +13, -2, +4, -4, -2, +29, -1. Those peaks in consumer sentiment index, when people are feeling good about everything, the market earns on average about 3%. When people are not feeling good about things, that's the valleys. Up 22, up 20, up 29, up 32, up 14, up 22, up 15. The market averages 24% going forward after the valleys. Green dot is where we sit right now. So you could argue consumer sentiment is not high right now. It is more on the lower side. Typically, that's a good time to have money invested. Doesn't feel good, but that's just the history of it. When the market's volatile, what do you think about doing? Well, volatility is good. You want to put money in when it's down, even though it's not what your mind tells you to do. But that's a good time to invest in retirement, non-retirement accounts, to contribute in, buy low. Second thing, considering Roth conversions. Roth conversions is where you take money from a pre-tax retirement plan like an IRA or 401k, and you push that into a Roth IRA. You can do that at any time. And the IRS likes you to do that because they get their tax money. Because when you move money from an IRA bucket to a Roth bucket, that's not considered a contribution. So you don't have to be under a certain income level to do it. You don't have to be working, or you can be retired and do a Roth conversion. But that's when you pay the taxes. Now, the benefit of doing that when the market's down, you pay the taxes at a certain level. And then when the market goes back up, all of that upside growth, the recovery, is fully tax-free because it's in a Roth now. So it's nice to invest in a Roth IRA like right after years like 2022, because we have the 23 recovery, and that entire recovery is tax-free then. Consider cash flow. And sometimes people can cut expenses when things are bad and you don't have to spend as much money. That allows more money to stay in the portfolio. And then when things recover, you've got more money to recover with. If you were thinking of retiring, you can delay retirement until the market is stabilized. And not that you have to do that. That's the whole point of financial planning, right? We want you to retire when you want to retire. And as you get closer to retirement, you don't want as aggressive a portfolio because you don't want to have to delay retirement because your market or your investments just went down 30, 40%. But really, those first few years of retirement dictate how much money you're going to have 30 years later, because your pot of money is the biggest. And if we have big drops right away at the beginning of a sustained withdrawal period, it's hard to recover from that. That's why, rule of thumb, as you get closer to retirement, you just have to be more conservative and not have 100% in stocks. And consider investing cash that's sitting on the sidelines. There is a huge amount of money in the money market right now. After 2022, they kind of track where money is invested. Does it go into stocks? Does it go into bonds? Does it go into the money market? The amount of money that was put in the money market versus stocks last year was astronomical. And that's kind of human emotions, right? 2022 is bad. Market was down. I don't want to put my money there. Putting it on the sidelines. And then the market goes up 20%. It's a good time to invest when you're seeing volatility. Consider rebalancing your portfolio. So as asset classes move up and down, if stocks, let's say you have 50-50 portfolio and stocks go down in the calendar year, now you're maybe like this, and the stock percentage is lower than everything else because stocks went down. You can sell some of your investments at a high point, buy some of your stocks, and you automatically are buying low. Brings you back to even. And then when the market takes off, that amount of money you bought has a big surge. For a lot of you, that's happening just behind the scenes for you. That rebalancing is done by us in your portfolios. But that's just a strategy you want to take care of in volatile markets. With technology posting strong market gains, be careful to diversify your portfolio and minimize capital gains whenever possible. You really don't have to worry about capital gains in a retirement account. In a non-retirement account, you do. But I mean, a lot of people are talking about those Magnificent Seven stocks that Kevin mentioned earlier. Not a great time to buy after you had the huge surge that you've had in those. Not that they're bad companies, but they don't have as much room to grow. So you just want to be careful to diversify and maybe sell some of the profits that are in those investments. Again, that's happening automatically in diversified portfolios for you. You can consider getting more aggressive and putting more in stocks. You can review gifting strategies in light of volatile markets, and there's a lot of different ways to do gifting strategies. That's probably another webinar to have. But ultimately, we just want to say thank you. Thank you for your trust. Thank you for the opportunity to help all of you with your retirement dollars. And what I'm going to do right now is I'm going to stop recording.